Latest news, Singapore Private Property Resale Index has dropped 0.6% month-on-month in January 2023. Today's discussion, I'll break down to three key parts for you. The first is I'll show you real data from private property in the resale market. Second, I'll give you some views on HDB resale prices because they seem to be heading the other direction. And last but not least, I'll give you a balanced view as to whether property prices will it crash or not. So if you're keen, continue watching on. Hi guys, welcome back. Without further ado, let's address what this headline exactly is mentioning about. Resale prices of private condominiums dropped for the first time in 28 months. Resale prices are not new sale because that is controlled by developer. Flash estimates has mentioned that RCR prices have came down by 0.2% and OCR have came down by 1.2%. Only CCR, which is Core Central Region, has risen by 2.5% from December to January. Now let's define exactly what are these terms, just in case you're new to the property segment. This picture actually mentions how it actually works. Core Central Region is the yellow one over there, which means Bukit Timah, Holland, Newton, Orchard, and of course including Sentosa. Later I'll touch on a bit in Sentosa, so stay tuned for it. That is CCR. Then outside that region is RCR, rest of Central Region. And then last but not least, everything outside, which is OCR, outside Central Region. I've actually heard this saying before, from Clementi to Ang Mo Kio to Bedok. This is the belt. So if you buy outside this is the OCR region. But as we know, recent news have been flashing out very rosy things, right, from developers. This is in the RCR region. Terra Hill achieves 38% sales on launch. Take note again, with an average selling price of $2,650 PSF. Wow. Terra Hill is actually in the Pasir Panjang region, so that is in the RCR. Then what about this? Also very recently, in the OCR region. Seneca Residences sells 60% of its units on first day launch at an average of 2,072 PSF. Seneca Residences is in Tanah Merah, which is in the extreme eastern side of Singapore. So in the RCR and OCR new sale, there seems to be new records all the time, correct? Very flashy headlines. But let me give some perspective as to why I think they are both very inflated. I actually have interest in this particular condominium. It looks very nice, and I've actually visited its showroom back 5 years ago, thereabouts, and this is none other than Principal Garden. Principal Garden is in the Redhill area, and if we can see in this snapshot, you'll realize that prices for Principal Garden condominium has actually increased in the last 12 months from December 2021 to 2022. And I've actually deep dived into it because personally I'm interested. So I'm sharing with you what I've discovered as I track. So as always, if you like this kind of content, smash a like, support this channel, and especially my hard work towards digging into numbers. What I realized looking at a comparable data point for Principal Garden is this one over here, which is actually a 2-bedroom. And we can actually compare what the price trend is to make some quick conclusions. I've actually found a data to piece into this, one that is transacted in 1st of September 2022 at a same block, block 95, and then one which was recently completed just a couple weeks ago. You realize that the September one, PSF was 2010, which is for a 20th floor unit, but then the latest one, which is completed for a 13th floor unit, maybe in the same facing, this one is 2% higher in this last 5 months or so. So indeed, Core Central Region properties may still be climbing in terms of asking prices. But my main takeaway point is, you see this project, it's 2,000 PSF only, right? It definitely seems better valued than, the one at Tanah Merah, the one at Pasir Panjang. I think the gems in the property market are definitely in the resale segment and quite possibly in the Core Central Region. And that's where I'll show you a second data set, which is actually in the Core Central Region, Sentosa. Now, I actually follow this company Hobby quite a lot. I think they are very smart in terms of how they've asset allocated. So what they do, I kind of learned a lot. When the sentiment in Sentosa properties was very bad, they actually just rented out properties. They didn't sell their properties out of distress. Sentosa properties have came down 50, 60 or even 70% below its 2010 peak. And just in case you don't know the project, Cape Royal Residence. Very beautiful, correct? You see over here, it's beach fronting in Sentosa. And the quantum sizes are 5 million and above. So definitely not mass market. But let me pull out some data points to show you what they're doing. This is actually in block 25 of Cape Royal Residence. The PSF for October was around 2002, but the latest transaction in January 2023, the closing price was at 2,223 PSF. So when I see decision making in Hobby, I see someone that is astute in how they approach their assets. Right now, they're still selling their properties. And maybe because this is a 17th floor unit, they are pricing it slightly higher, but also the expectation is not sky high. They're not inching it up by 11% like what we would imagine. They've only inched this up slightly. This case study on Cape Royal really explains a very important part. When we invest in property, we need to have holding power. For the last 10 years or so, the sentiment was terrible. So what they did was just rent it out, and now markets are going up. They're not also asking for the moon, they are releasing units already. That tells me at least that markets are rich, and reinforces also why previously I rented out and now I've actually sold off my own HDB flat. Just in case you're curious about that story, I'll be releasing a sequel to it. Gary Vaynerchuk has this very good saying, watch what I do, not what I say. So smash on subscribe. I'll be sharing a bit more as to why I've actually sold my HDB flat in a sequel coming up very soon. A key takeaway can be this. Core Central Region prices may still be strong, but what we see is weakness already in OCR and RCR. I think the macro headwinds will impact all sectors of it, and therefore I believe the overall index may finally be trending downwards. Now, property prices and property sentiment is way slower than stock market. Stock market, 1 month crash, next month can rebound, just like in COVID period. But property prices are very slow moving. Once the trend is established, it goes for many months. That is also a reason why when it was on the uptrend, it actually managed to ride up for 28 consecutive months. Something to note. And that also brings us to the second part of today's discussion, which is on HDB price trends. That looks to be still very strong. As you can see over here, HDB resale prices have climbed a further 1.4% from December to January. Not just that, $1 million transactions have now surged by 42% in total numbers. The resale transaction volume for HDBs is still very strong. You see over here that January actually clocked a higher volume of transactions than December 2022. This again is contrary to the private segment whereby transaction volumes have been declining. And that's where I would like to raise a point. Are we really giving too much grants for HDB resale or not? Because in budget 2023, new HDB buyers can qualify for an additional $30,000 CPF grant. From previous discussions, I've also asked this question. Every year we seem to be increasing this grant limit. I understand that it's to help new home buyers to afford their first house, especially if they are from a lower income segment. But perpetually increasing this grant always signals to the market that there's more affordability. And that could really be a factor as to why HDB prices have not came down despite big macro headwinds. Will government be better off signaling a stop to the grant increment? Or maybe in 2024, pre-signal early that the grant increment is only going to be $10,000 instead of $30,000. Then naturally that could cool expectations, and that could really tell buyers that, government won't always give you a grant to afford your first home. You need to look for something cheaper and start to negotiate a bit better. Maybe that's where already prices will start to cool for the HDB segment. And as always, if you have your views, do leave in the comment sections. Let's be constructive, because what we want to help is for Singapore property markets to be vibrant, but also for affordability to be for each and every household. So everybody is from a different background. We want to take care of each other, and that's where property debate for policies should actually take place. Let's now move on to the third segment for today's discussion, which is on whether property prices would crash or not. I've actually had previous episodes before. I don't know if you've seen this. I'll leave towards the end of this whole tutorial also. But let's start with some headlines that's impacting properties overseas. Let's look at Australia. They have recorded 9 straight months of property drop. And year to date in January 2023, you see a 7.2% decline already. Big cities are the ones that are hit the most, Sydney, Melbourne included. But from a conversation with a private client, I also hear that Perth prices are still pretty strong. So in Australia, the city performance is also very different. What about for New Zealand? They have declined 13.3%. Auckland is the one that seems to be the hardest hit, dropping by 21.7%. Australia and New Zealand are definitely not the only ones expecting a decline. You see in Europe, you see in Vancouver. Property price declines seem to be experienced all over the world. That is why it's not just me who's doubting whether property prices can continue to climb in Singapore or not. You see over here that international news have also questioned whether Singapore home prices would defy gravity for long. Because again, the last time we registered a drop in property prices for private segment was in September 2020. Could it be that Singapore property prices are not immune, but rather we are lagging what's happening all over the world? Our property price decline will come, but probably in 2023 and 2024 only, simply because it wasn't as bullish as the rest of the world. This is why this hypothesis could be true. If you see this URA publishing, you realize that our unsold private property pipeline is actually pretty dry. It's been flat for the last few quarters and declined from its peak in 2018. The total units of unsold private properties is about 16,900 currently, which is about the same as a year ago. So is 16,000 units high or low? We have to compare against yesteryears, correct? And I've actually done the homework for you. That's why I smash the like button. But let me show you this. You see that in the previous property peak in 2013-2014, the unsold residential units hovered around 30,000. That peak was experienced again in 2018 when we saw another en bloc wave coming up. But as of right now, it can be argued that the supply pipeline is just not too inflated. And if supply is not too inflated, the odds of a crash is not that high. But again, it doesn't mean that it will not decline. To me, it just means that the odds of crash is not too high. But what could really come down? I think that is in the rent segment. If you see this chart over here, you realize that Singapore property rental rates have skyrocketed, correct? I think you also have heard of news already. This is the one that I think could be bubblish. And if we scrutinize, there could be big changes coming up. You see over here that there is a lot of supply that is going to be completed in 2023. Big projects in Normanton Park and in Avenue South, for example, these are going to be completed in 2023. A total of 19,291 if we do include ECs. And this huge supply just means that there are a lot of people looking for tenants. Not all who buy are looking for homestay or for family stay. There are a lot of investors, especially in the shoebox units. And when supply starts to come in big flows like that, it could really disrupt the rental rate sentiment. If you have wondered why this supply is coming at such a big force, a simple answer to that is construction problems back in COVID period. I've pieced together some information using data from 2018's URA report. You see that the expected completions were 12,000 and 16,000 in 2021-2022. But as we know, COVID has slowed down construction phases. That is why all that supply has been pushed back to 2023-2024. Interesting finding, correct? And since you stay with me to here, I have a last food for thought. There are so many properties completing this year. What if there are owners who have high commitments elsewhere with this high interest environment? Would they be more ready now to sell? Take note again, when they bought a couple of years back and what they can sell now is definitely a profit already. And as we know, when we have profits, we kind of take profits very easily versus someone who is on the losing end who want to hold on to it for dear life. Buying from construction end to now, there's definitely a slight profit. And if you were to think in their shoes, they could feel the pressure and they could really think about selling below their original expectations in 2023. For example, your neighbor previously wanted $1 million, but right now because of high interest costs and stuff, he or she has decided to actually sell it off at $970,000, $30,000 off the original asking price. And once you start to see enough neighbors selling below their asking price and taking smaller profits, you realize that that is actually how property prices start to slowly come down. Make sense or not? Leave your thoughts in the comment section as always, and thank you for watching to here. With that, I'd like to invite you to some of my previous discussions. This one over here touches on properties being 15 years and above, whether they still have appreciation or not. Check that out, or check this, which might be something you are interested in also. With that, sign off from me and see you there too. Take care as always. Goodbye.